the number of people who qualified very easily on the A side and are now being forced into the B side is up drastically, right? I think, even with the stress test, like we bought our house in March and it was a pre-con, so it's a little bit different, right? But we bought the house that we live in right now in March and we the bank stress tested at like 5.25 or whatever it was back then, right? But now we're at 5.5 on our primary residence, right? And so as much as we all bitched about the stress test, like, yeah, it was kind of useful, right? And we're probably going higher, right? So people's personal qualifying is drastically dropping because Scotia adjustable as are a lot of investors, right? And our mortgages are genuinely going up. Even if you weren't and you were in like a fixed payment variable, right? You probably hit your trigger rates and your trigger points, and those payments are going up as well, right? So across the board, the biggest issue is just qualifying. Like prices haven't come down nearly as much as people's qualifying power has gone down.
You've heard it in the news. You read it in the headlines. More interest rate hikes, lower home prices, talks of recession. If you're a real estate investor, you may be asking yourself, what now? This week, we sit down with Mayu Thava to talk about everything from navigating the current market and making tough choices when evaluating your portfolio. You're listening to the Black Wealth Effect podcast, where we're all about inspiring the next generation of Black Canadian real estate investors to succeed financially. If you're tuned in, that means you're hungry to take action and build wealth outside of your 9-to-5. We'll be sitting down with Black real estate investors, entrepreneurs, and allies to discuss a diverse set of topics to help you along your investing journey. Let's get started.
What's going on, everyone? Welcome back to another episode on the Black Wealth Effect podcast. Before we jump into the interview, I would love for you to help us out with two quick things. First, make sure that you subscribe and review this podcast on whatever platform that you're listening to us on. And secondly, check out our Facebook group, the Black Wealth Effect Network. Here you can connect with us, and we plan to provide massive value on this platform. You'll have access to a greater community where we can all grow and build wealth together. So now that we have that out of the way, let's jump into the interview. And today we have a very special guest with us, none other than the one and only Mayu Thava. Mayu, welcome to the show. How are you feeling today, man?
Doing good, guys. How are you guys both doing?
Yeah, we're doing good, man. Trying to, make some sense of this market. But I guess after this conversation, you would help us with that. So
I'm still trying to make sense of it too, man. So it's kind of like going to be the blind leading the blind right
now. So, we know you as an accredited investor and more recently successful, mortgage broker. If you were to go back in time before, you started real estate investing, what advice would you give your younger self?
That's a good question, actually, because personally, I like my journey, right? I think about whether I could have done things differently, probably taken a little bit more risk early on, probably gotten a little bit more educated early on. But I also think post, I'd call it 2017, kudos to Matt McKeever, right? I think he really started off in the Canadian real estate, just publicly publicizing for free a lot of the investing strategies that we implemented, right? So sometimes I think about where could I have even learned about this stuff, right? And there was very limited resources. There's stuff in the US, right? So looking back, I went down the CPA, CA route, got the good job that my parents were super happy with. Should have just kept going down that route, bounced back and forth between I'm gonna be a fucking partner and fuck this shit, I'm out, right? So are we allowed to swear? I don't even know. Yeah. Okay. Go ahead. So I bounced back and forth between that, but along the way, lived at home, lived super lean, I'm sure a lot of you guys did, save as much money as possible, right? Dip into the different lines of credit to make aggressive investing decisions, right? And kind of scale up from there. Yeah, I guess the main piece of advice, I guess in hindsight, would probably be to get out there and network a lot more than what I was doing, right? So I come from the Sri Lankan Tamil community, and great community. The downside though is when you're like super heavy in your community, you almost don't know what other people are doing, right? So the community is great, all that stuff is great, and you guys belong to your own communities as well. But I think stepping outside of that, stepping outside of the areas and the communities that we grew up in, like our high school friends and like university friends or whatever, right? And just talking to more people that come from different upbringings, right? Really expands your horizon and what you know.
Yeah, I think we're all guilty of that in the early stages, myself included. So really stepping out and connecting with like-minded people, super, super important. So that's a great piece of advice there. But again, you're a successful investor with multiple different strategies. Could you talk about your latest deal and share like high-level numbers?
Yeah, sure. So we bought two properties, both closed in October. So I'll talk about the one that closed first. The one that closed first was actually a cottage deal up in Minden, Ontario. So that one came from like a wholesaler that I know pretty well. I was actually going to fund it for him. I was going to be the capital partner. And then he wanted to assign it, right? He's like, look, like I'd rather take like an assignment fee right now. Like if you want to take this on yourself, right? So I'm like, okay, cool. So then I reached out to my network of potential capital partners. Buddy of mine from university, he's actively wanting to like invest, and he basically became the capital partner. I became the active partner. From back when like I used to flip a little bit more, not even aggressive, but when I used to flip more, I had contractors that were willing to like move around quite a bit. The downside with cottage country, because cottages are great, everyone loves it, right? The downside is contractors and just any kind of help you need is super expensive, right? Which I kind of understand, because most people don't move out to cottage country because they want to build a construction business. It just doesn't happen, right? So then this is kind of going back and forth a little bit here, but we did a flip in Tiny, Ontario. And when I bought that flip, I tried using local contractors. So the first one that I had quoted me 150 grand for a single family house renovation, nothing really requiring like electrical or plumbing, nothing like that. Super basic shit, right? I was like, well, fuck that. I'm definitely not doing that. And then I got another contractor out there who came in at 30 grand. I'm like, okay, this is really cheap. I almost have to like give this guy a shot just to kind of see how this plays out. He took about like 2 months just to like demo and like barely did any work. And I'm like, all right, you got to go. And then it just got really messy there, like small claims court and like all this shit. I'm like, all right, just like, here's like 3 grand or whatever it was. Just don't bother me again. Right. So that experience going into this cottage, I was like, okay, I know my biggest issue is going to be labor. It's going to be getting materials on time in cottage country, right? Getting people to even do like windows, doors, roofs, like stuff like that is a big pain. So I reached out to my contracting team that helped us on the flips, right? And just schedule them in, pay for a hotel, get them out there, right? Do the renovations. So we closed that mid-October. We're basically to the point where now we just have to do flooring and put in a new kitchen, and we got to do a little bit of drywall, right? And so what we realized is it was an oil tank ran out of oil. And then obviously you realize, hey, well, like there's no more heat. What's going on here? And then you realize that oil tank is not being used, right? So now we got delays because you got to get a furnace in, and in cottage country to get a furnace is about a 6 to 8 week wait. So that's where we're at right now in that deal. But we bought it for, I believe it was about 360, maybe it was 365, somewhere around there, right? 360. And every deal has a backstory, right? Like that one, I was working with the wholesaler, so I knew the backstory. And you know, even when him and I were trying to lock it up together, the seller just kind of ghosted us for a month. So we were like, you know, don't really know if we're getting this house, like don't really know what's going on. Find out later that the seller was in jail for a month, and that's why he wasn't like responding to us. But he basically came out and he was like, tell me what price you guys need, and like, let's sell this. Like, I got to sell this house and like move on, right? So it worked out. So we got that deal. It's under renovation right now. When I bought it, very conservatively, like if you guys look up Minden, Ontario, it's not on the water, but it is a 5-bedroom, about 3,000 square foot house on, I believe it's just under like 2 acres of land, right? So it's a nice, like right beside it is kind of like vacant land as well. So it's not like there's neighbors even around it. There's actually like an abandoned, like, I think it was a Corvette and like an abandoned like airplane unit, or those like small, like 2-seater like airplanes. Like it's just there. I'm like, this is a fucking sick paintball field, but can't advertise that because it's not my land, right? But you know, will we take advantage of it? 100%, right? So there's a lot of cool shit with that one. Expecting ARV to be minimum like 700. What we're like forecasting for like our worst case is like, okay, like if we end up at 600 to 650, are we okay? We're probably going to spend about 100 grand on it, right? So you buy it for 365, you're in it for another 100, all in it 465 plus your carrying costs, which is like, we closed it with the private because the seller's ex-wife was living in the house and wouldn't let an appraiser into the house. So we had to close it with a private sight unseen. So that's about $3,000 a month that we burned there. So all in 6-month project, 100K renovation, probably 20 to 25K in closing costs and holding costs, right? So you're going to be basically in it for about 500. So if you hit that 650, you're basically pulling out all of your money minus the net investment that we'll have for furniture and stuff like that, which we were pretty okay with, right? And then, yeah, the plan is to take it to Airbnb, but I'm a little bit apprehensive on it. It's going to be my first Airbnb, really. I do have a furnished rental, but I have a couple of student rentals, stuff like that. But yeah, not to keep talking, but like the problem with Airbnb is it's very much another active business that I'd have to build out. And I'm kind of like, I don't know if I necessarily want to do that. So that's where we're at right now on that one.
That's great. And definitely a lot of different variables you have to navigate, or it sounds like you're navigating through just with that project.
You know what it is, man? Like usually every project that's been lucrative for me usually comes with a handful of like problems, right? And so like that's what we ultimately get like rewarded for, right? Like paper flipping and like speculation and stuff like that. I kind of agree with the mass public that it is wrong, right? If you're just taking inventory off the market and trying to resell it in like 6 months with doing minimal work, it's probably not the right way to do it, right? But if you're genuinely adding value and you're taking a house that was a little bit dilapidated and you're making it into a livable, like quality asset, or you're solving someone's situation where the individual comes out of jail, he's got an ex-wife living in the house who won't let anyone into the house, stuff like that. A normal individual is going to come off the streets and go, hey, I'm going to buy that with a private mortgage. I got a team that's going to come in and like renovate this thing, right? So we get rewarded as investors for solving problems that other people just don't want to deal with, right? And that's kind of the part that the media doesn't really talk about. Yeah, like I was telling you guys before we started recording, I guess, like there's an offer that I'm literally looking at today, and its seller is going to lose a house in, I think it's this February 25th is a payment that he can't make. So like we have to close the house probably within like 30 days and get him out of it if he takes it, right? And people will walk through it and the house does not look presentable, right? Because if you don't have money to pay your mortgage, you're probably not taking care of your house. It's just the reality of it, right? So yeah, I think overall investors get rewarded for the risk and problems they solve. That's my 2 cents.
Facts. So just to piggyback off of what you said, obviously the market has shifted substantially in the past 6 to 8 months. From a broker's perspective, what are some of the trends that you've seen as an investor?
You say from a bird perspective or a broker?
Broker, sorry.
Broker, okay.
My bad.
Yeah. What are some of the trends, right? That's what you're saying?
Yeah. As an investor and the lending side, like what are some of the trends that you're seeing?
Yeah. Okay. So, I mean, let's talk about it from the investor side first, right? I think cash flow across the board is almost a conversation of yesterday. Like there's not much cash flow left when you're at 6 to 7% interest rates, right? That becomes a major struggle on its own because you never want to be in a situation where you're bleeding on each property. Imagine you're bleeding on a property and then you lose your job, right? And then it's like, well, like now you really can't carry, and that's where you become a motivated seller yourself, right? So you never necessarily want to be in that situation, but getting cash flow is more and more challenging in today's world, right? So that's definitely a major constraint. Appraisals are another major constraint, right? In a downward market, for you to be renovating something that's going to take you 6 to 12 months and then hoping to refinance out of it at a higher value than what you bought it for in a downward market starts to become a challenge on its own, right? Because you got to make sure that deal really has enough juice, right? Some of the stuff that we've been dealing with more so over the last 6 months, right, I think is people that bought in Jan, Feb, March, right? And they started their renovations and then they go to refinance come September, October, November. And it's like, well, I don't even know if you could get anything out on this property, right? Like you bought for like 600 and now those same properties are selling for 400, you renovated. So maybe your property is still worth 600, right? But you spent the money on renovations, right? So the investing market, it's definitely gotten hit, right? And I think the people that bought to flip, I think struggled the most, right? Because a lot of those assets, like if you were flipping in like Richmond Hill, you got to sell. Like there's no other exit here, right? Like even if you put this thing on Airbnb, like how much can you really make? But I have clients that were flipping in, say, like Sault Ste. Marie, right? And it's like, okay, like could we like refinance you out of this and like put you in like a commercial product or something like that? That makes a little bit more sense, even if you don't qualify, right? And then I guess, yeah, that goes into like the broker space, right? I think in the broker world, the number of people who qualified very easily on the A side and are now being forced into the B side is up drastically, right? I think, even with the stress test, like we bought our house in March and it was a pre-con, so it's a little bit different, right? But we bought the house that we live in right now in March and we the bank stress tested at like 5.25 or whatever it was back then, right? But Now we're at 5.5 on our primary residence, right? And so as much as we all bitched about the stress test, like, yeah, it was kind of useful, right? And we're probably going higher, right? So people's personal qualifying is drastically dropping because I'm in a Scotia adjustable as are a lot of investors, right? And our mortgages are genuinely going up. Even if you weren't and you were in like a fixed payment variable, right? You probably hit your trigger rates and your trigger points, and those payments are going up as well, right? So across the board, the biggest issue is just qualifying. Like prices haven't come down nearly as much as people's qualifying power has gone down.
Right. Those are good points. You talk about properties that are bleeding and the headaches that come with that. For those investors who, once again, may have been positive cash flow 6 to 8 months ago that are now negative cash flow, what advice would you give them? Are there like specific products that they should start to consider? Like, I'd imagine a good first step is connecting with a broker such as yourself.
Yeah, I mean, obviously, like definitely talk to a broker, right? But also talk to your realtors, right? I think it requires a good power team to come together and figure out what is the solution here, right? I think everyone's situation is going to largely depend on themselves and what their personal finance situation is, right? I was listening to, I think, Mark Loeffler on his YouTube channel just saying, sell your dogs now, right? Like sell like the shitty assets that you have, right? That you maybe kept before because it was going up like 30, 40K every like 6 months, right? Now might be the time to just let go of it, right? Because if it's bleeding we have no idea how long we're going to stay in this down cycle for, right? So do you really want to hold it in an extended down cycle, right? Now you might kick yourself in the foot later and go, shit, like the market recovered in 6 months and then I sold, right? But at the same time, it's all about risk management, right? So if you're someone that has a significant pool of liquidity, you could probably weather a storm holding on to your dog assets, right? So maybe you don't need to necessarily liquidate it, right? But if you're someone that has like 5 or 6 flips on the go, and each one is underwater, like you might want to strongly think about just maybe taking the 50, 60K losses on these properties and selling them off anyways, right? Just kind of risk control. So I think across the board, I think, if you're someone that is in that situation where you've struggled over the last year or so, right? I think you got to just look at your risk profile, right? How much liquidity do I have? How long can I weather the storm right now? And if the answer is in at least like 1 or 2 years, I think you got to strongly think about just taking the losses today because you don't know what the losses will be tomorrow, right? So like we're selling a single family house in Windsor that myself and Austin actually own together. That one we refinanced back in, I feel like it was like maybe 2020, and we took out all of our money. And then the asset value probably went up to like 380, 390, something like that, right? We're selling it today for, I think it was like 300, right? And so we're walking out of that with, between me and Austin, like 30 or 40 grand, right? Which is, it's not going to move the dial in either direction, right? It's 20 grand each. Like it is what it is, right? But we've already taken out all of our capital before, right? And we're just looking at it as this mortgage isn't really getting paid down. There's about $100 a month in cash flow. Any capital calls that come in for this basement, the property, like the furnace going out, like a break-in, like a appliance repair, like $1,000 for a new stove or whatever it is. That's 1 year's worth of cash flow gone, right? So if there's no mortgage pay down, there's no price appreciation, and there's really no cash flow, right? Then what are we holding on to this property for? Even if we like just have 30, 40 grand worth of equity in it, it's still a waste of money, right? So look at your portfolio, rebalance, and kind of reassess is what I would say. And yeah, for sure, talk to your realtors, talk to your mortgage brokers, talk to your lawyers if you need to, right? Figure out what you got to do to kind of rebalance the portfolio.
Nice. Yeah, and to your point, I agree. Like, it's definitely important to be objective about it and like truly just evaluate your situation, right? Like making sure you're putting that pride aside and not just holding on to the property for the sake of holding on to it. Like if you're not making money, it's extremely important.
Yeah. And the beautiful part about it is like, even if you saw it a loss, right? Like, or not a loss, but if you saw it a down cycle, which is what we're essentially doing with this single family house. But I'm looking at it as I'm probably going to take my 20 grand, just maybe drop it in some bank shares or something like that, like stock market, right? And I'll get my 6% dividends and I'll ride the wave as those appreciate eventually over time as well, right? So it doesn't mean you just take the money out and you just kind of like go and do something else with the money, like invest it in today's market, right? So then the question becomes, are you really losing anything if you're buying in the same market?
Yeah, those are great points. And so if we pivot a little bit and just think about like, or talk about the investors that are looking to get started in today's environment, like what advice would you give those folks that are listening?
Yeah. Okay. So if you're a new investor in today's market, I think, okay, so I guess you can break up the market into two segments, right? One is definitely investors. And I think this podcast is more targeted towards investors, right? Okay, cool. So if you're an investor, I think what you want to stay away from is the crazy big renovations, right? I think that's where you have the biggest risk, the biggest exposure, and you're going to be tying up like renovations aren't cheap, right? Like we're talking about a cosmetic renovation on the main floor of the property we checked out today and then doing the basement, and we're talking about like 120 grand, right? And that's like on like a single unit. Now imagine it was like multi-unit, multi-family, stuff like that. A lot of renovations aren't cheap, right? So you want to buy the properties that you can strategically renovate for a limited amount of capital, right? And try not to get into these crazy 1 year renovation projects where you've got holding costs and you're burning money left, right, and center, right? Because you don't know where the market will be in a year. So I think new investors stick to easier to manage projects, right? And I also think pooling together assets and funds is a great way to risk manage, right? So if, for example, like Ron, you're going to buy one property, Mario, you're buying another property, instead just pull together your funds and buy two properties, right? Put each of your funds like half into each property. And you've naturally got a little bit of kind of like risk, like diversification here between the two properties, right? So I think that's a big part that like not enough people talk about. I think together you can do much more than individually, right? And then you now have a bigger asset base to continue riding the wave up. And it's not like you bought less just because you're buying together, right? So in conclusion, I think investors stay away from crazy big renovation projects in today's market, focus on getting in, getting out, and focus on trying to find good partners to partner up with and pool funds together, right?
Yeah, I would say those are really good points. You know, risk mitigation is so important. And I love that last point where you're like, share the risk with, with a partner instead of trying to go it all alone. That really jives with me. So good information there. But on the flip side, you know, for private lending, we've heard you talk about the importance of doing your due diligence to assess the asset more or less, understanding your exit strategies as well as determining the worst case scenarios for that deal. So for a first time private lender, how would you recommend they go about doing this, especially in today's market?
Yeah. So I'm just assuming that people know here what private lending is, but if you don't, it's essentially a form of lending to other investors or other home buyers in exchange for a fixed rate of return plus maybe some fees on top of that, right? So I've been private lending ever since I graduated university. Not that I had money to private lend myself, right? But it was basically, I would just take money from my line of credit, which I feel like at that time was maybe like 6 or 7%. I have no idea why I think this, but let's just call it 6 or 7%. And I had a cousin who's a lawyer and he's like, I always get these private lending deals. You want to just give me your money? I'll give you 12%. I'm going to turn around and reloan your money out, right? So I gave him that. I just made the spread of 6% very carelessly and more so based on trust, right? And this is something that I think for most investors, whether you're looking to raise private money, if you're looking to raise private money, the people that will give you the money for the cheapest and the fastest with the least amount of questions are the people that know and trust you, right? Now, once you go into call it the secondary market, like people that maybe don't have a direct relationship with you. And if you're coming in this from a lender's perspective, right? A lender has to be the most concerned with what is your actual project here, right? Like, are you just getting into a private because you have no way of qualifying for a traditional or B-side mortgage? If that's the case, well, then what the heck is your plan to repay me, right? That's got to be a question that everyone thinks about. If you're getting into a project and you need some funds for renovations, right? You got to vet the deal. Like, how much are they buying it for? How much are they saying after repair value is? You got to go and look at after repair value. Like, how realistic is that? And then what if like after repair value starts to slip, right? Is this individual going to be in trouble? Do they have other assets that they can use to pay me back with? Stuff like that, right? So I think, so from start to finish, someone reaches out to me, they send me the deal. I assess the deal first, right? So what are you buying it at? What kind of renovations you need to do on here? And what are you saying it's going to be worth after? And everyone has to assess whether or not those numbers are realistic. And if they're not realistic, probably wouldn't necessarily go out calling the individual out on it, right? But I do my own numbers based on what I can see as being realistic. Like people will tell me, hey, I'm going to renovate something for like 40 grand. I'm like, it's probably like 60 to 80 grand, right? So you got to have your own numbers and your own experience behind it. Same thing with after repair value. And then you got to look at if this individual isn't able to like hit his numbers, does he have another plan to repay me? And if that plan fails, like in the case that it's a flip that he can then maybe burr, what's his worst case? Does he have other liquidity? Does he have other assets that maybe we can refinance something else and get that money back to the ultimate private lender, right? And I keep going back to this deal that I literally looked at today because it's a perfect example. Like The individual, the property that I checked out today, they had a B lender mortgage in the first, and then they had a private second on it for 110 grand, which pushed the total debt on the property to 740. I'm trying to buy it at 700, right? So whoever gave that 110K private second is probably going to be taking a haircut on their loan, right? Because the sellers just don't have the money to repay them, right? So just make sure you're being cognizant. Don't just take after repair values for what people tell you they will be, right? Do your own due diligence and get into private lending very cautiously in the current market. It was easy to repay private lenders in the last 5 years, right? In the last 6 months, not so much.
So I'm curious, how would someone ascertain ARVs in this kind of current market? How difficult would that be? And I'm guessing you would have to leverage someone like yourself or your realtor and really, get really granular and start studying what that expected ARV is and does it match up with what the borrower is asking.
Yeah. I mean, you're kind of right here, right? Ultimately for the average Joe to go and say, hey, I'm going to assess ARV out in Sudbury, there's going to be a challenge behind it, right? Even if you're a realtor in Ontario and you don't pay the licensing fee to be registered in, or whatever that fee is called, to be registered on the Sudbury board, you're just not going to be able to see comps, right? So I think for the average individual, there is going to be a struggle there. But if we're all investors that can understand the market, right? It's just literally calling a realtor, right? Getting comps yourself. Talk to people that you know that are investing in that market. See what duplexes, triplexes, whatever are going for in that market. Assess the reasonability of it. Now, you should also always be getting an appraisal done on any kind of private that you're giving, right? So whenever something it needs extensive renovation, you can do what's called an as-is appraisal and then an as-if complete appraisal as well, right? Now, that's really when you're really unsure. I've given private loans in Timbuktu, areas that I know nothing about, right? And then it's more so the appraisal, calling the appraiser and saying, hey, did you actually give this value? Or someone creating some fraud docs and sending it to me, Because you got to be careful on a lot of stuff in today's world. When people are desperate for money, they're desperate for money, right? So, and then just understanding what do you assess is the overall situation in this market? Are things just sitting on the market? Are things moving, right? Because lack of liquidity is also another risk, right? If you're in these rural areas, real estate just doesn't sell that fast, right? Versus at least if you're in a city, it should in theory move a little bit faster.
Yeah, that's really solid advice there. So yeah, that do your due diligence and make sure that your ass is covered, basically.
Yeah. Yeah. And ultimately, if we're all investors, I'm sure you guys know how to go and determine your after repair value for a project that you might be looking at, right? So it's the exact same level of due diligence that goes behind assessing ARV. Maybe you don't have to be as crazy with it, right? I'm more crazy the higher the loan to values that I'm getting to, right? If I'm going up to 85, 90, 95% loan to value, shit, I'm digging into this thing like crazy, right? If this is sitting at 70, 75, 80%, I'm okay, there's about a 20% margin of error here. I'm probably not going to be in too much trouble.
Yeah, definitely. And I mean, since we're on the topic of private lending, could you talk about, what a MIC is and your advice? What would your advice be to someone considering to invest in a MIC?
So MICs are private lenders. They're basically a pool of investors that technically you're investing into a MIC. And so you're investing your capital into it in exchange, usually for a preferred rate of return, right? So for example, I actually invested in my very first MIC as well back in 2017. It wasn't a lot of money. I just knew someone that was setting it up. And I think I gave him 10 grand or something like that, right? And so they gave me back 8% every single year. And I was okay, this isn't that bad. Now you can invest into a MIC using your RSP or your TFSA as well, right? Which is what I did. I think I used my RSP at that time. So you get the tax deduction for contributing 10K to your RSP, and then your RSP is earning 8% every single year, right? So then what the MIC will do is they'll take pooled funds from multiple individuals as investors, right? And they will then turn around and lend that money back out into the market. They need to make sure that they're generating at least an 8% rate of return, right? So they might be lending their money out at 9 or 10%, keeping in mind that a MIC will have at any period of time money sitting in the bank account that isn't loaned out that they still have to pay 8% on, right? So the only way they can do that is if you're consistently generating a higher than 8% rate of return, right? And then MICs make really their money as well from charging lender fees as well, right? So that's where if you're an investor that borrows money from a MIC and they charge 1 or 2% as a lender fee, right? That's where that money is going to. It's kind of the MIC's owner's profit margin a little bit, right? And MICs are great if you want to avoid doing a lot of the work. MICs have historically been great. I think in the last 6 to 8 months, you've heard of various MICs facing liquidity crunches or capital calls, basically like investors looking to take their money out of the MIC, right? Because if you're a MIC that was giving 8 or 9% as your rate of return, home equity line of credit rates are now at, and mortgage rates are now at 6, 7, depending on like where you're talking about, right? So a lot of the time, if you're getting an 8% rate of return, I might as well just take that money back and pay off my mortgage, which is 6.5% rate of return. And there's zero risk associated with that, right? So MICs have started increasing their rates so that they can offer better rates of return as well. But it is just something to be careful of. Make sure that if you invest in a MIC, assess that MIC's liquidity, assess their financial statements. Don't be afraid to ask for them as well, especially if you're investing in it.
Really good advice there. And I'm not sure if you mentioned it earlier, but could you clarify for our audience what MIC stands for?
So a MIC is a mortgage investment corporation, right? And I'm not 100% sure about this side of it, but I believe there's a part in the CRA, like Tax Act, that allows for a MIC to be created. And it's basically a flow through entity, right? Where the MIC is able to write off the preferred dividends that are paid out to its equity shareholders, which normal corporations aren't able to write off the dividends that are paid out, right? But a MIC is able to, and it's something to do with like this preferential like tax treatment for a MIC. And as a result, there's a lot of regulation and stuff like that goes behind it, right? So as much as you or I would probably love to create a MIC, I've looked into it briefly and I'm like, there's a lot of red tape behind this thing. It's probably not worth it unless you have like millions of dollars of scale behind you.
Yeah, like hundreds of millions. You're right.
Yeah.
Mm-hmm. Yeah, and you touched a little bit on kind of the due diligence associated with obviously evaluating a MIC and the fact that it's obviously a regulated entity. Like, and you obviously shared like what one should do when evaluating like a private lending deal. Mm-hmm. Are there any other kind of key differences and kind of the extent or the level of due diligence amongst both?
Yeah. Very big differences, I'd say. So I think if you're going to be a direct private lender, you need to assess every single deal that you're lending money on, right? And the rate of return that you will get on every single deal is directly correlated to usually the level of risk associated with that deal, right? So I've done deals where we get like a 10% rate of return. I've done deals where we've gone like a 23% rate of return, right? Purely tied to like, hey, is this in like a rural area? Boom. Like that's like one mark against you, right? Like what's your credit score as a borrower, right? Like what's your overall liquidity assessment, right? So whenever I send out deals to like people that lend for me now, we almost just do like a risk assessment, right? It's like property. So that's where like after repair value, renovations, like stuff like that comes into place, right? Geography of the property, like is it liquid? Like how many properties are actually selling? Is the type of asset that we're lending on in demand, right? And then borrower profile, right? What's a borrower's overall income, credit score? Do they have other assets that they can kind of lean on? Honestly, do they have wealthy parents, right? Like something like that. Okay, cool. Like at least I know like there's an exit plan here, right? So you got to consider all that if you're going to be a direct private lender, right? So if you're going to be investing in a MIC, there's multiple MICs out there, right? So you really got to look at all the different types of MICs. Each MIC almost specializes in different things, right? So in the brokering space, we oftentimes go to MICs to fund fix and flip projects, right? Some MICs only deal with individuals that don't qualify for traditional mortgages, right? Some MICs will only lend in Ontario. Some MICs will only lend in Alberta. Some MICs will only lend in the GTA. Like there's a bunch of MICs that will only do GTA, right? So you can almost choose the type of MIC that you want to be invested in. Oftentimes, though, like if you're a GTA only MIC for individuals that can't qualify for traditional mortgages, your rates of return that you're able to give to your shareholders are usually going to be less than MICs that act as construction lenders, right? So it is usually tied, the rate of return is tied to the level of risk that a MIC is willing to accept. But the type of loans that a MIC can give out is oftentimes stipulated before a lot of investors come in, right? Because as an investor, if you think you're going to invest in a MIC that only lends in GTA and then they start doing construction loans, you're going to be kind of pissed, right? Because it's still your money at risk, right?
Mm-hmm. Yeah, no, those are all great points and definitely a lot of great food for thought. And we definitely appreciate you sharing your experiences and insights throughout this conversation, Mayu.
Yeah.
To kind of round this out for this episode, can you just share? So you're once again, like you're obviously someone who wears multiple hats. Like you're investor, broker, coach. I'm probably missing a few other things. Can you share like what's been kind of your secret sauce to your success? And then like what's next for Mayu after 2023?
Yeah, that's a good question, man. I think so. I started off as an investor first, and then naturally from there, I went into the flipping game. So I was doing buy and holds, and then I was doing birds, and then I was doing flips, right? And then from there, I started off into the coaching space a little bit, still dabble there a little bit. I'm not that aggressive on the coaching space right now, right? And then mortgages is really like my bread and butter, right? So right now, the focus for me moving forward is more so growing the mortgage business, right? I did realize, and this is probably important for I think people that listen. I think if you try to do too many things, you end up being kind of a master of none or jack of all trades and expert of none or whatever that phrase is, right? So for me, it was like I really had to slim things down. Not the greatest market to be flipping in, so that was the easy decision. Stop the flipping, really winding down the coaching, stop doing individual coaching calls, really winding down the coaching that I do with other coaches as well, right? And just focusing on pure investing and purely mortgages, right? So mortgages is the active business. That's kind of like the equivalent of a 9 to 5 or a job, right? Where you're like grinding away at that for your active income. And then you realize that you still need to be investing, right? So that's kind of the two kind of levers that I'll pull on. I encourage people to kind of focus in on a few things rather than trying to take on too many things. Go a mile deep in the one or two things that you really enjoy, right? What's next for me? Like, honestly, a lot of it is doing the same thing that I've always been doing, right? And I've tried multiple things. Like, we were talking about this earlier. I started off in GTA, went to Windsor, went to New Brunswick, to have a project in Sudbury right now. I have a project in Cottage Country, stuff like that. But I think geography now is the same shit to me, right? Like I really invest anywhere. So I kind of view investing in these smaller, like duplex, triplex, fourplexes for the most part to be a lot of the same shit, right? Super easy to find the deals, especially in today's market, a lot more risk managed, right? So it's like, why try to do something new for no reason? Are you then just complicating your life, right? Just do the same thing, the bread and butter that kind of rewarded you. Just keep doing that just keep improving your kind of skills on that. And then, yeah, the mortgage business, definitely a big focus. I would say I am looking at the US as well. Because as much as I say I'm going to do the same thing, bread and butter over and over again, you do get a little bit tired and bored and you want to try something new, right? So investing into the US is more so something that I'm not necessarily in a rush to do, but will probably do within the next 12 months.
Wow. That's fantastic. And so we'll definitely have to have you on for a second episode to kind of see where you're at in the next few months for sure.
Yeah, for sure, man. Appreciate it, guys. Thanks for having me on.
Yeah. Thanks again for joining us, Mayu. For our listeners, thanks for tuning in to another episode of the Black Wealth Effect podcast. We'll catch you later. What was the one thing you heard today that inspires you to take action? Now plan to take that action in the next 24 hours. If you're looking for more support, ideas, or just want to connect with others like you taking action, join us in the Black Wealth Effect Facebook group. The link is in the show notes. Thank you for listening, and we'll catch you next time on the Black Wealth Effect podcast.